Assalamu alaikum and hello everybody. This is Zeeshan Hasan. We are now starting with our lecture of SBR, which is on goodwill, and it is with the aspect of the consolidation. Right, very important topic. You should learn it very carefully from start till the end. Uh, let's start with it. Okay, firstly, again, which we the area, the definition which we looked at in our previous lecture as well. That is a definition of a business. A business combination arises when acquirer obtains control of a business. Okay, a business is an acquired set of activities and assets that includes the minimum an input and a substantive process that together significantly contribute to the ability to create outputs. And what was that minimum? It was minimum voting rights of 50%. That means minimum 50% plus control should be obtained. Minimum 50% control should be obtained. If you remember, like we discussed in our previous class, we discussed in very much detail, right? So uh, the acquisition method, a combination that is an acquisition should be accounted for using the acquisition method. IFRS 3 requires that acquisition method is applied to a business combination at the time of the acquisition. Firstly, in it, identify the acquirer. One entity must be the acquirer. Number two, determine the acquisition date. That is the date on which control is obtained. Uh, Number three, recognize and measure the identifiable assets acquired, liabilities assumed, and non-controlling interest in the acquiry. Number four, recognize and measure goodwill or a gain on a bargain purchase. The acquirer is the entity that obtains control of another entity as defined by the IFRS 10 consolidated financial statements, where a business combination primarily involves an exchange of equity interests. The acquirer is usually the entity that issues its equity interests. Okay. Now, what is goodwill? A goodwill, an asset representing the future economic benefits arising from other assets acquired acquired in the business combination that are not individually identified and separately recognized. Okay, this is goodwill, asset representing the future economic benefits uh, which parent company will get from the other acquired assets from a subsidiary company in the business combination, okay, which are not recognized individually by a parent company. That's a goodwill, okay. As far as the goodwill calculation is concerned, goodwill is calculated as the difference between cost say cost of investment. So you can say cost of investment or cost of consideration transfer, consideration transferred plus any non-controlling interest. In short, we do say it NCI, and the fair value of the acquirees identifiable assets and liabilities at the date of the exchange transaction. So, so how to compute it? Acquisition date, that is fair value of the consideration transferred, or you can say cost of investment. COI. Okay, non-controlling interest in the entity acquired, less acquisition date fair value of identifiable assets and acquired assets and liabilities assumed, we will get goodwill or bargain purchase. What is bargain purchase? We will look at it in detail later on. But now, right now, we can say bargain purchase is actually a negative goodwill, right? So far, so good. As far as the non-controlling interest is concerned, IFRS 3 permits a choice of measurements for the NCI, non-controlling interest. It may be measured on an acquisition by acquisition basis at fair value at the acquisition date, or as a proportion of the fair value of identifiable net assets of the acquiring. Okay. So at the acquisition date, the amount of NCI included in the goodwill calculation is recognized in the consolidated financial statements within equity. The NCI subsequently allocated its shares of the subsidiary post acquisition total comprehensive income, and this is added to the initial measurement of NCI in equity. Okay. So here, the exam advice from my side is that non-controlling interest should be measured using the specified method, uh, which is specified in the exam question and the information provided. Don't worry about it. I will do it in detail in the upcoming examples as well as the exam questions which we will practice. Here it is. First example. Parent acquires 80% of the subsidiary of for $120,000. Okay. So what we found out, 80% of subsidiary for 120,000. The fair value of the NCI share in subsidiary is 28,000. While the value of the NCI based on the proportionate share of individuals, okay, we basically gets it mostly gets it on two bases. One, as specified here, the proportionate basis. And that's one. The share value. So the share of identifiable net assets acquired is 25,000. The fair value of the subsidiary net assets on the acquisition has been determined as 125,000. Calculate the goodwill that may be recognized on the acquisition. So far, so good. Let's look at it simple. Cost of investment. $120,000. 120,000. Simple. In example one, or you can say A, the value of NCI is specified 28,000. Given in the question, I just did control C, copy, paste, control V. NCI 25,000. That's it. You got the total till now 148,000 and 45,000. Fair value of net assets, the same at both sides. And you got the goodwill. 23,000 and 20,000 respectively. Here, the detailed explanation. And look at it very carefully. If the NCI is measured at fair value, part A, okay, that is my part A over here. The NCI will be higher to the extent of NCI's goodwill. That is the axis of the fair value of the NCI over its share of net assets. The NCI share of goodwill is 3,000 of the total of 23,000. This represents 13% of that total goodwill. It is highly likely that the percentage of goodwill attributable to the NCI will be disproportionate compared to the actual shareholding 20% in this example. This would be due to the parent paying a premium to acquire control. Got the point over here? Now, this is the difference only and nothing else till now. We are going step by step, so do not worry, as we have several issues to address. What is included in the cost of acquisition? That is consideration transferred only. Now, identifiable assets and liabilities. Yeah. The fair value, the uh, fair value adjustments recognized, and how goodwill arising consolidation accounted for. Okay. Uh, Features of goodwill. The main features of goodwill can be measured as follows. It cannot be measured separately. Its value may fluctuate widely over time. Valuation can be highly subjective. It exists because of factors which are difficult to identify with precision. Goodwill. Now, the point to remember, and it is a, or you can say it is a key point, that goodwill may be internally generated or it may arise on acquisition. However, only acquired goodwill is recognized in the financial statements. Do not recognize internally generated goodwill. Got my point? So the basic principle IFRS 3 requires that purchase consideration is measured at its fair value. This is the amount of cash or cash equivalents paid and and the fair value of any other purchase consideration given. Now the deferred consideration. What is deferred consideration? In simple terms, I said to someone, listen to it, listen to me carefully. I said for example, I'm buying something from you, right? I'm buying your company. Uh, well, so I said I'm giving you 1 million now, and I will pay you another 100,000 after 1 year. So that's 100,000, which I'll be paying you after 1 year. This is deferred consideration. So any deferred consideration is measured at its present value. Okay. Any deferred consideration is measured at its present value. Right. So that means the 100,000 which I have to pay after 1 year will be measured at today's interest rate. If cash is to be paid sometime in the future, the amount will need to be discounted to present value, and that amount included as fair value in the total cost calculation. This increase in present value through the passage of time will be finance cost charged to profit or loss. Now, here another example. Example to goodwill and deferred consideration. Parent acquired 60% of the subsidiary for 100,000 cash payable immediate and and $121,000 after 2 years. See, 100,000 immediately, 121,000 after 2 years, $121,000 after 2 years. So the fair value of the subsidiary identifiable net assets at acquisition amounted to 300,000. Okay. Parent cost of capital is 10%. Okay. The deferred consideration has not been accounted for when preparing parent financial statement at 31st December. ACCA parent choose to measure NCI as a proportion of fair value, right? The second method which I told you. So calculate the goodwill arising on acquisition. Show how the deferred consideration should be accounted for in parent separate financial statement. It's still painful. This illness. Uh, by the way, goodwill 100,000. We have to calculate the goodwill cost of investment, right? So while measuring the cost of investment, two things. One, the cash which we paid immediately, 100,000. The next one, 121,000 after 2 years divided uh, by the so capital 10%, 121,000. 10% effort consideration has been accounted for after preparing, and they will be paying after 2 years, right? So simply, this rate will be giving to you in the exam. I took it over here directly, right? The cost of capital was 10%. So the rate for after 2 years is 0.21% actually. So very simple, 121,000 divided by 1.21. It will given to you in the exam. So don't worry. 1.21. So the total we get is the present value of it altogether 200,000. Okay. Then NCI value 300,000. And we are getting overall 60%. So NCI will be 40%. Very simple. 300,000 into 14%, we get 120. Fair value of identifiable net assets, 300. We got overall 20. Now, as far as the deferred consideration is concerned, for first year, double entry at 1st January for the first year. The cost of investment in subsidiary is 100,000. Deferred consideration, cost of investment in subsidiary debit, and deferred consideration, since it's our liability now, will be credit. Simple. On 31st December, due to the unwinding of the discount, the deferred consideration will equal how much? See, 121,000 divided by the interest, the cost of capital 1.10 on the year end of year one. It will become 110,000. Okay, 110,000. Now the this 10,000, the extra 10,000, parents' retained earning will be debited by 10,000 and deferred consideration, the liability will be credited. So the next year, 110,000 divided by 1.1 will become 121,000. If the consolidation dated statement of financial statement at 31st December in the current year, the cost of investment in subsidiary will be replaced by the net assets of subsidiary plus goodwill of 20,000 and the deferred consideration will be 110,000. But in the second year, goodwill will remain 20,000 and it will become 121,000. Okay. Contingent consideration. So when a business combination agreement provides for an adjustment to the cost contingent on future events, the acquirer includes the acquisition date, fair value of the contingent consideration in the calculation of the consideration paid. If the contingent consideration will be settled in cash, a liability will be recognized through the issue of additional equity instruments. The credit entry will be to the equity. Any change to the contingent consideration that arises within the measurement period and that are due to additional information obtained relating to the acquisition date result in the remeasurement of goodwill. That is, the revised consideration is reflected in goodwill. Any change that arises after the measurement, the period does not affect the original calculation of the goodwill. If settlement will be in cash, the consideration will be remeasured each reporting date. At each reporting date, and any change recognized in profit or loss. This settlement will be through an equity issue. The consideration is not remeasured, and any change in value on eventual issue will be included within equity. Share exchange. It is quite common for a parent to acquire shares in the subsidiary by issuing its own shares to the previous shareholder in a share exchange. The cost of acquisition is number of shares issued into market price of parent shares at the date of acquisition. And we did such things in our financial reporting FR or F7 exams as well. So it's very simple. Let's look at the example. Parent company acquired 80% of share of subsidiary, 100,000 shares, 3 for 5 exchange. The market price of one share in P on acquisition was $4 and that of S was 2.20. Right. Now the requirement is determine the amount of consideration for the investments. So here is the solution. Very simple. Cost of investment is equal to 100,000 shares into 80% into 3 divided by 5 into 4. We got 192,000. The market value of subsidiary share is irrelevant in this case. Okay. Now takeover of share-based payments. When an acquirer agrees to replace an existing share-based payment award that has already been issued to the employees of an acquiree, the fair value of the replacement share award that relates to the pre-acquisition period forms part of the consideration paid to the seller and is so included in the goodwill calculation. The fair value that relates to the post-acquisition period is recognized as a staff cost as required by IFRS to share-based payment. Okay, here is another example. On 1st January 2001, Olive granted share options to its employees when their total share was 2 million if employees remained in service for a period of 4 years. Okay. On 1st January 2003, Almond acquired 100% of the equity shares in Olive for cash consideration of 29 million. Almond is required to issue replacement share options to employees of Olive that will vest on 31st December 2004. At the acquisition date, the fair value of the Olive net assets was 26 million. The fair value of the original share option was 2.2 million, and the fair value of the replacement award was 3 million. Calculate goodwill on the acquisition of Olive. Well, see, cash consideration 29,000. I'm reading million as thousands. Okay, don't worry. Replacement share options. That's my working. I'll show you in a while. Right now, just believe it's 1100. Net assets 26,000 negative. Given in the question, will you get the goodwill? 4100. Now the working. See carefully. The fair value of the original share options at the acquisition date was 2.2 million. Vesting period, original and replacement scheme, 4 years. Consideration for the acquisition is therefore 2:4 into 2.2 million, that is 1.1 million. No, the note, the fair value of the replacement option at the date is 3 million. Therefore, 1.9 here, 3 million, this 3 million here, and the 1.1 million consideration. Total, therefore, 1.9 million is the post-acquisition service amount that is recognized as the cost spread over the 2 years to the vesting date. That's it. I hope you get it. Right? So, sorry, this is not FRS 3, it's IFRS 3. Transaction costs, IFRS 3 requires that transaction costs, including the legal cost, legal fees, advisory costs, or the valuation fees incurred on the acquisition of the subsidiary are expense in the period they are incurred. Acquisitions costs do not form part of the fair value of consideration transferred and are not included in the goodwill calculation. Costs related to the issue of share or debt are treated in accordance with IS 32 financial instruments presentations or IFRS 9 financial instruments. This will generally mean that they are recognized equity. As the recognition is concerned, acquired and liabilities assumed on the business combination are recognized separately at the date of acquisition and therefore featured in calculation of goodwill. This may mean that some assets, especially intangible assets, will be recognized in the consolidated statement of financial position, and even if they are not a portion in the subsidiary's single entity statement of financial position. Okay, remember this. Any future costs that acquirer expects to incur in respect of plans to restructure the subsidiary must not be recognized as a provision at the acquisition date. They will be treated as a post-acquisition costs. Now, the very important point which you should keep remember that expected restructuring costs of an acquisition are not liabilities of the acquiry at the date of acquisition. Therefore, they are not relevant in the allocating the cost of acquisition. Companies historically recognize large provisions on acquisition, and this had the effect of reducing net assets and thereby increasing goodwill. Goodwill was not then charged and against profit. though amortization over a much longer period than through immediate recognition as an expense. IFRS 3 and IS 37 have virtually eliminated this so-called big path provisions. Okay, intangible assets of the acquiree. Firstly, very important point. Intangible assets should be recognized separately from goodwill if they meet the definition of asset and are identifiable. An intangible asset, remember, it's an revision for you, is identifiable if it is separable. That is, it could be separated and sold, transferred, or exchanged either individually or with a related contract, asset, or liability, or it arises from contractual or other legal rights. Two, intangible assets that may be recognized on consolidation therefore include customer lists, separable internet domain names, order backing, trader secrets, contractual. Okay, contingent liabilities of the acquirer is 37. Provisions, contingent liabilities, and assets does not allow contingent liabilities to be recognized in the financial statements of a single entity. However, if a contingent liability of the subsidiary has arisen due to a present obligation that does not being recognized because an outflow of economic benefits is not probable, IFRS 3 requires this present obligation to be recognized as a provision as long as fair value can be measured reliably. The provision uh, is recognized on the business combination only and therefore appears only in the consolidated statement of financial position. Now, here's the exam advice. If a question states that subsidiary has a contingent liability on an acquisition, recognize it as a provision in the consolidated accounts. Reacquired rights. If the acquirer in the business combination acquire rights that it had previously granted to the acquiree, that right is separately identifiable asset on acquisition and is not subsumed into the goodwill. In and in definition, assets are the asset is the provision of a guarantee by the seller regarding the downside of the risk associated with the acquiry. For example, where an acquiry has a legal claim against them as a result of pre-acquisition events, the seller may provide an identification assets by promising to reimburse and acquire for amounts paid under the claim. This type of asset is recognized and measured based on the same measurement principles and assumptions as the related liability. In practice, this type of asset is usually measured at the same amount as the related liability, subject to contractual identification limits. The acquisition of the subsidiary, IFRS 3 requires the recognition of certain assets and liabilities in consolidated financial statement that cannot be recognized in the financial statements of subsidiary because they do not meet the framework criteria for recognition. Example, internally generated intangible and contingent liabilities, as this is not inconsistent. Surely, if these assets and liabilities exist at the date of acquisition, they should be recognizable in the subsidiary's financial statements. The apparent discrepancy may be explained by the fact these items cannot be measured reliably in the subsidiary's financial statements. and it is only the acquisition that attributes a cost or value to them. Measurement. All assets and liabilities of the subsidiary which are recognized in the consolidated statement of financial statements are measured at their acquisition date, fair values with limited exceptions of accordance with the relevant standards, that is, deferred tax, employee benefits, share-based payments, transactions, non-current assets held for sale, etc. Okay. Each asset and liability is measured as if it was separately acquired on the date of acquisition at its fair value. This is likely to reduce the amount of goodwill that would otherwise be recognized. Example, if carrying amounts were used instead, this may mean that the carrying amount of individual assets and liabilities is adjusted at acquisition for the purpose of calculating goodwill and preparing the consolidation. Example 5, the goodwill. On 20th August 2006, acquired 80% of $1 million one equity shares lead, electing to measure the non-controlling interest at fair value. Okay, the agreed consideration was 12 million cash payable on 20th August 2000X at 6 million loan notes payable on 19 August X9 and conditional upon lead achieving revenue targets and one share in BML for every acquired in Leith at acquisition. Leith had retained earnings of 15.9 million and other comprehensive income of 2.1 million at the acquisition date. The fair value of the NCI was 3.75 million and the fair value of contingent consideration was determined to be 4.5 million. The price of the BML share was 12. The financial statement of the Leith at acquisition included a balance of 150,000 due to be BML in goods delivered. The balance was settled at acquisition and formed part of the cash by BML on 20th August exit. Leith had not recognized in its financial statements the internet domain name for its online shop. Professional valuers have indicated that this was worth 100,000 at the acquisition date. Now the requirement is discuss the measurement of goodwill on the acquisition of Leith, how to approach the question. Firstly, look at how to approach the question. Calculate the goodwill. Number two, discuss each line in the calculation, explain the IFRS 3 requirements and how they have been applied. So here it is a solution. See, goodwill is calculated with IFRS 3 as the difference between the consideration paid plus the NCI and the fair value of the assets acquired and liabilities assumed. Considering 12 million, 5,000 minus 150, the legal fees, etc. So it's 11,850. Contingent consideration, 4,500 mentioned in the scenario. Share for share exchange, 1920. NCI 3750. Net assets at carrying amount, share capital of parent company only, share retain earnings, combined 15,900, other components of equity 2,100, domain name 100, total we got 19,100, and we got the goodwill 2,920. So here, now we have to explain the basic principle and all. Here it is the basic principle of IFRS 3 is that consideration is measured at fair value. In the case of the cash consideration, this is 12 million, right? In the acquisition date, the financial statements of Leith A receivable balance due from BML of 150,000 was reported. This was settled by cash consideration in the acquisition. Thus, 150,000 of the 12 million cash consideration transferred in respect of existing relationship. So the IFRS 3 states that this is not consideration for the business combination. Instead, BML should debit its trade payables with this amount. So far, so good. The loan note consideration is contingent on lane performance, and IFRS 3 requires that contingent consideration is included in the goodwill calculation at the acquisition date fair value, regardless of the probability of the payment. A further 4.5 million consideration is therefore included in the calculation. Okay, where a share per share exchange forms part of the consideration, it is measured at the fair value of share issued. BML acquired 800,000, 80% at 1 million of shares in REIT and offers one of its own shares for every five. Therefore, it issues 160,000 new shares. 800,000 divided by five, they are measured at the market value on the acquisition of 12. The share consideration is therefore 1.92 million. So 160,000 into 12. Got it? The NCI represents 20% shareholding not acquired by the BML. IFRS 3 offers the choice of measurement, fair value, or as a proportionate of net assets. The choice is available on an acquisition by acquisition basis. BML has selected to measure the NCI at its fair value of 3.75 million. The choice means that recognized goodwill include NCI goodwill. IFRS 3 requires that assets acquired and liabilities assumed in a business combinations are measured at fair value. The carrying amount of 19 million, 15.9 plus 1 million plus 2.1 is therefore adjusted to include any identifiable intangible assets and have not been recognized in the lien own financial statements. The internet domain may meets the definition of asset because it is within the control of LEAP and result in future economic benefits. It is identifiable because it arises from contractual rights. Therefore, the 19 million carrying amount of net asset is increased by 100,000 fair value of the domain name. Now here it is. On 1st October 2008, Hawaii purchased 8 million of Texas 12 million equity shares. The acquisition was financed as follows. Sorry, it's too much irritating over here on the skin right now. Uh, a cash of 2.0 per share, 1.20 per share payable on 1st October 2008 and 0.80 payable on 30th September 2009. Any discounting calculation should be performed using a cost of capital of 8% per annum. A share exchange of one equity share in Hawaii for every two shares acquired in Texas. The market value of a Texas was 3.90 on 1st October. Exit. The market value of Hawaii shares were 4 on 1st October 2008 and 4.20 on 31st March X9. A further share issued by Hawaii on 30th September X9 of 1 share for every 8 shares acquired in Texas, provided the profits after tax of Texas exceeded a given figure. Estimates indicate that this share issued is likely to be made the fair value of this contingent consideration on 1st October X rate was 4 million. This has increased to 4.2 million at 31st March X9 as a result of post-acquisition performance of XRs. Hawaii incurred acquisition costs of 600,000. 350,000 of these costs were external due diligence costs. 100,000 were Hawaii's best estimate of management time spent in negotiating the acquisition, and 150,000 were costs incurred in connection with the issue of Hawaii shares. Directors of Hawaii carried out fair value exercise on 1st October exit and following matters emerged. The net assets of Texas that were reconsidered in Texas on financial statement were 13 million. Okay, in the individual financial statement of Texas. On 1st October, the carrying amount of Texas freehold property was 15 million. The market value of this is now 22 million, of which 12 million relating to the building element. Okay, so far so good. On 1st October 2008, Texas was engaged in contracts with three different customers under which it supplied each customer for 5 years from 1st October exit. The directors of Hawaii believe that this creates an intangible asset with a fair value of 7.5 million. Okay. So in addition, the directors of Hawaii believes that the fair value of the assembled workforce of Texas creates an intangible asset with a fair value of $15 million. The average remaining working life of the employees of Texas at 1st October exit is 15 years. Neither of these intangible assets has been recognized in the individual financial statements of Texas. At 1st October, XA, the directors of Texas had advised by in-house legal team that a customer intends to bring a case for damage against it. The legal team has assessed that the case can be successfully defended and have made no previous for the payment of damages in its financial statements. The directors of Hawaii estimated that the fair value of any damages payable at 1st October 2008 was $6,000. Due to the acquisition of Texas, the directors of Hawaii intend to reorganize the group starting in June 2010. The estimated cost of this reorganization is 20 million. The non-controlling interest in Texas was measured at its fair value of 17.5 million on the acquisition by Hawaii. The requirement is discussed with supporting calculations. The goodwill on acquisition of Texas as initially measured at 1st October 2008. So see, the goodwill is calculated according IFRS 3 as the difference between the fair value of consideration provided plus the non-controlling interest and the fair value of identifiable assets acquired by the liabilities assumed. Goodwill on the acquisition of Texas was 1st October exit is calculated as fair value of consideration given non-controlling interest, fair value of net asset acquired, as you can see here, right? Fair value of consideration 35,526. I will explain you the working in a while. And fair value of net asset acquired 44,500. Again, the goodwill, the working. Okay. So the basic principle IFRS 3 is that consideration is measured at fair value. Consideration may take various forms, and in this case includes an immediate cash payment, a deferred cash payment, an immediate share for share exchange, and contingent share considerations as well. The fair value of the immediate cash payment is cash transferred. The fair value of the deferred cash payment is present value of the payment payable in 1 year's time. This is discounted at cost of capital of 8%. The share for share consideration is measured at the fair value of the share issued. The Hawaii issued 4 million of its own shares at the acquisition, where the market value of each was 4, and therefore the $4, right? And therefore the fair value of the element of the consideration is 16 million. Contingent consideration is recognized. Measurement of the fair value reflects the profitability of the payment, and therefore probability is not further reflected in this form of consideration. The fair value of the contingent share consideration is 4 million at the acquisition date, and this amount is included in goodwill calculation. Subsequent changes in fair value not reflected in goodwill unless they occur during the measurement period and reflect conditions that are existed at the acquisition date. In this case, the increase in fair value is due to the post-acquisition performance of taxes, and neither in the case nor in the balance in Hawaii's equity are measured. The acquisition costs incurred by the Hawaii are not part of this consideration. The cost of the external due diligence and management time are considered as expense when incurred. The share costs are recognized in accordance with IS 32 in equity. Okay. IFRS 3 allows a measurement choice of NCI, and this applied on the acquisition by acquisition basis. In this case, Hawaii has elected to measure the one of three NCI at its fair value. This is acceptable regardless of how the NCI of on any other acquisition may have been measured. IFRS 3 requires that the identifiable net asset acquired and liabilities assumed are made fair value. This may result in some times that are not recognized by the recognition on the value. This may result in other being remeasured. The carrying amount of the net assets Texas date is 30 million, and this is the starting point of the calculation of the fair value of identifiable assets acquired and liabilities assumed. At the acquisition date, freehold property owned by the Texas has a fair value is 7 million in excess of carrying amount. This is recognized as a fair value adjustment to the net assets of the net assets of Texas subsequent to acquisition. The increase in carrying amount of building will give rise to additional depreciation in the consolidated financial statements. At the acquisition date, Texas has identified two potential unrecognized intangible assets: customers, relationships, and the workforce. An intangible asset is recognized on consolidation if it meets the definition of intangible assets and is identified. If it is separable of or arises of any form of contractual or legal rights, the customer relationships will result in probable economic benefit and are controlled by the taxes as a result of past events. These arise from the contract, and the contract meets the criteria to be recognized on acquisition at fair value of 7.5 million. The force does not meet the definition of asset because it's not controlled by the taxes. Therefore, this is not recognized on acquisition. At the acquisition date, the Texas has a potential legal dispute and contingent liability. IFRS 3 requires contingent liability recognized at acquisition if it is present obligation as a result of past event that is not recognized because an outflow of economic benefit is not deemed possible. In this case, the customer has not yet brought a case against Texas, and therefore there is a possible obligation rather than a present obligation. The contingent liability is therefore not recognized. The intention of the directors of Hawaii to reorganize the group in the future does not create an obligation of Texas at the acquisition date. Therefore, this is not reflected in the measurement of acquisition date liability. So here is, as you can see, what fair value of consideration given immediate cash payment 1.20 into 8 million shares, 9,600 deferred cash payment, 8 million into 0.80 divided by 1.08 as the present value 5926. Share exchange 4 million into 4, 16,000. Contingent consideration 4 million. Acquisition cost nothing, 35,526. Next one is fair value of net assets acquired as per financial statement of Texas 30,000. Adjustment of for property 7,000. Adjusted for customer relationship 7,500. Everything else, including workforce, reorganization, and contingency, are nil. So 4,500. That's it. So far, so good. Provisional accounting. If accurate figures cannot be assigned to elements of the business combination, estimates and provisional amounts are assigned to acquisition. Any new information has become available relating to date, assets, and liabilities retrospectively adjusted against the amounts recognized as long as the information in the period. IFRS 3 identified the measurement period as period after the acquisition date, during which the parent may adjust the provisional amounts recognized for the acquisition of subsidiary, right? So the measurement period cannot exceed 1 year after the acquisition date. Subsequent adjustments after the measurement period, the only revisions would to be correct errors with IS 8 accounting policies, changes in accounting estimates and error. Here is the example, parent acquired 80% of subsidiary on 1st October X1, okay, for 60,000. The fair value of the subsidiary identifiable net assets at the date of acquisition was provisionally measured at 62,500. However, parent is continue to work confirm the fair value of the land owned by the subsidiary. The non-controlling interest was measured at acquisition using the proportionate share of net assets method. 31st December X1, goodwill has been impaired by 1,000. In the year following the acquisition on 31st March, it was identified that the fair value of the land was 2,500, greater than the provisional amount, and the measurement period of further impairment loss of 600 arose in the respect of goodwill in year 2. Calculate goodwill at the 31st December 2000 X1 and 2 year ends and prepare the required journal to adjust goodwill in X2. Cost of investment 60,000, NCI 62,500 into 20%, 12,500. Net assets on acquisition 62,500. Goodwill on acquisition 10,000. Impairment loss 1,000 at year end 9,000. In 31st December X2, cost of investment 60,000. NCI 62,500 plus 2,500, 13,000. Net assets on acquisition 65,000. Goodwill on acquisition 8,000. Impairment loss 600 at year end 74. So that's it. The journal entries land debit 2,500, impairment loss for the year 600, goodwill 9,000 minus 7,400, 1,600 credit, NCI 2,500 into 20%, it will be credited by 500, and retain earning will be credited by 1,000 because of impairment loss for goodwill reversed. Okay. Another activity we have on 1st October 2001, Pico acquired 100% interest in Spartan when Pico issued its 31st December 2001 financial statement. The valuation of an acquired trademark was incomplete. Pico estimated 1 million as the provisional fair value of trademarks and a 5-year life. On 30th April X2, valuation of the trademark was finalized. The fair value at the acquisition date it was to 1.2 million. Discuss how people should reflect the acquired trademark in the calculation of goodwill and its consolidated financial statements. So here it is. PICO should initially recognize the trademarks in the calculation of goodwill at the date of the provisional fair value of 1 million. The amount is also recognized as an intangible asset in the consolidated statements, financial statements, initially measured at 1 million. Subsequently, the trademark should be amortized over 5-year life. A carrying amount of 950,000. How? 1 million, as you can see, minus 1 million divided by 5 years life into 3 divided by 12. As of it has 3 months for the current period. So total 950,000. Since the initial measurement is provisional, IFRS 3 allows the work to finalize fair value take place during a measurement period. This lasts until earlier of 12 months after the acquisition date and the date on which the required information is obtained. In this case, 30th April X2, when the finalized at the acquisition date, fair value of 1.2 million is determined. Retrospective adjustments are made to the accounting for the business combination in the comparative amounts for 2001 as follows. As you can see, one, the carrying amount of trademark of 31st December X1 is increased to 1,140,000. The increase of 190,000 represents the increase in fair value of 200,000 less 10,000 additional amortization from the acquisition date to 31st December X1. As you can see, zero point 0.2 million into the 3 divided by 60 months. Amortization expense of 2000 X1 is increased by 10,000. Goodwill is decreased by 200,000. Fair value in financial statements of subsidiary, the fair value adjustments may or may not have recognized in the financial statements of the subsidiary at the date of acquisition. In the exam, they will not have been. They must therefore be dealt with before consolidation. A fair value adjustment up or down should be made to the net assets of the subsidiary at acquisition in your exams. Okay. Unless the related asset has been disposed of since acquisition, this adjustment is also required at the reporting date. If the related asset is depreciable, the reporting date adjustment takes into account cumulative depreciation on the adjustment since acquisition. The share of total comprehensive income allocated to the NCI should be after consolidated adjustments, including depreciation on fair value adjustments. Any goodwill in the subsidiary separate statement of financial statement position is not an identifiable asset and must be written off by reducing retained earnings at acquisition and at the reporting date. For example, as you can see, parent company and subsidiary financial statements, non-current assets, tangibles, 1,800 and 1,000. Cost of investment in associates, 1,000. Current assets, 400 and 300. 3,200 and 1,300. Share capital, 100 and 100. Retained earnings, 2,900, 1,000. Current liabilities, 200 and 200. Total is 3,200 and 1,300. Further information, parent bought 80% of subsidiary on the 31st December X6. At the date of acquisition, subsidiary retained earnings stood at 600 and a fair value of its net assets as 1,000. The fair value difference was due to an asset that had a remaining useful economic life of 10 years as at the date of acquisition. The NCI is measured at a fair value on acquisition. The market price of subsidiaries shares on acquisition was 12.4 share. Goodwill has been impaired by 40 since acquisition. Prepare consolidated statement of financial position of parent as at 31st December X8. Now the solution is non-current assets 208 as per the working tool, which I'll show you. Tangible assets 1800 plus 100 plus 300 minus 2 into 10 into 3000. 300, we got 3040. Current assets 400 plus 300, 700. Share capital 100. Retain earning as per working 3140. Non-controlling interest 308. Current liabilities 200 plus 200, 400. Now look at the net assets company. Share capital same of parent company only. We will not consider as companies. Retain earnings 100 and add acquisition 600. At consolidation it is 1000. So 400 is the difference between pre and post. Fair value adjustment. At acquisition it was 300. Now it is 240. So it was just adjusted, as you can see, for 8 months out of 10. Goodwill. Here is the calculation cost of investment 1000. Fair value of non-controlling interest 100 into 20% into 12.40 to 48. Net assets acquired 1000. 248 carrying amount 208. Impairment loss 40. In the same way, NCI fair value on acquisition 248. Share of post-acquisition profits 314 to 20%, 68. Share of goodwill impairment 40 into 20%, 8. Consolidated retained earnings parent. Here you can see 2900. Share of subsidiaries 80%, 1340 minus 1272. Goodwill impairment 80% of 1432. So overall retained earning is consolidated retained earning is 3140. Okay. Now, you may be asked to discuss the calculation of goodwill on acquisition and or required to account for goodwill by making entries in pre-populated consolidated spreadsheet. It is therefore important to be confident in how goodwill is accounted for as well as how it is calculated. Positive goodwill measurement. Goodwill reflects the future economic benefit arising from assets that cannot be identified individually or recognized separately. Initially, it is measured at cost and recognized as an asset. Subsequently, it is not amortized but tested for impairment annually. Consolidated adjustments to recognize goodwill involve adding together the assets, liabilities, income, expenses of a parent subsidiary on a line-by-line basis and then posting consolidation adjustments. That is the journals, the consolidation adjustment to recognize goodwill also ensures that the NCI, any fair value adjustments are recognized and the cost of investment in the subsidiary and the subsidiary's equity and reserve at the acquisition date are eliminated. Here, statement has been prepared whether the individual statement of financial position of quarter and subsidiary Stanley on a line-by-line basis. No adjustments have been made in it. Remember, see, property, plant, and equipment, cost of investment in Stanley, current asset, total asset, equity, share capital, retained earnings, total equity, current liabilities, total equity and liabilities. Further information, Porter acquired 90% Stanley on 31st December at least at a cost of 1.1 million at that date. Stanley had share capital of 250,000 and retained earning of 550,000. The fair value of one of its properties was 200,000 in excess of its carrying amount. Porter chose to measure the non-controlling interest in Stanley at its fair value of 127,000. Requirement: calculate goodwill arising on the acquisition of Stanley. Adjust the draft consolidated statement of financial position of Porter at 31st December 2008 in order to prepare a corrected consolidated uh, statement of financial position at that date. Um, so here it is. Cost of investment, you can see 1100. NCI 127. Net assets acquired. Share capital, retain earning, fair value adjustments, PPE, overall, and then we are getting 227. Good. Now the exam advice you can see over here. This calculation derives the required consolidated adjustment to make any entry for each line item in the calculation. It is convenient to consider the component parts of the carrying amount of net assets acquired, that is share capital, retained earnings, and etc. See, for partway A, goodwill on calculation, consolidation adjustment to record goodwill on the acquisition of Stanley. Therefore, goodwill debit 227 to record goodwill. Share capital debit 250 to eliminate Stanley share capital. Retain earning debit to 550 to eliminate Stanley's pre-acquisition retain earnings. Debit property, plant, and equipment 200 to record the fair value adjustment. Credit cost of investment 1100 to eliminate investment in Stanley, and credit 127 NCI to record NCI in Stanley. Now the corrected consolidated statement of financial position at 31st December X8, you can see over here property, plant, and equipment 3400, which we take it from above part, added 200, 3600. Cost of investment in Stanley 1100 minus, it is adjusted. Goodwill 227, added. Overall, it is now 3827. Added 900 here, become 4500, and it is adjusted to 4727. Share capital minus 250, adjusted to 500. Retain earning adjusted by minus 50, 3300 adjusted, right? Retain earning adjusted by 12700 over here. 3927. Current liabilities are the same. That's it. Now again on bargain purchase, a negative goodwill. If on initial measurement the fair value of the investment of the acquiring net asset exceeds the cost of acquisition plus no controlling interest and excess, the acquirer reassess the fair value of net assets acquired, that uh, all relevant assets and liabilities have been identified and the fair value of the consideration transferred. Any excess remaining after the reassessment is recognized immediately in profit or loss and attributed entirely to the parent. IFRS 3 refers to this as a gain on bargain purchase. This excess gain should have arisen due to so the fair value of net assets acquired, the fair value of the consideration transferred, and the fair value any excess remaining after the reassessing is recognized immediately in profit and loss attribute date and entirely to the parent. IFRS 3 refers to this as gain on a bargain purchase. This excess gain could have arisen due to future costs that have not been reflected in the acquisition process, the measurement of the items not at fair value, if required by an other standard example, deferred tax liabilities cannot be discounted for sale at a low price. So here is another exam advice. A bargain purchase is recognized in consolidated statement of profit or loss in the year of purchase only. Okay, it will not come after it. And consolidated statement of profit or loss for the years are not affected. However, consolidated retained earnings in the consolidated statement of financial position is increased in the year of purchase and in the later years until the disposal of the subsidiary. As far as the impairment testing is concerned, for the purpose of impairment testing, goodwill must be allocated to a cash generating unit that benefits from the acquisition. A CGU, cash generating unit, need not need not necessarily be a unit of the subsidiary acquired. It could be a unit of the parent or another subsidiary in the group. The unit must be at least that of an opening segment as defined by IFRS 8 operating segments. Each CGU must be tested annually for impairment. The test must be carried out at the same time each year, but does not have to be carried out at the year end. Any impairment losses expense to profit or loss. As far as partially owned subsidiaries concerned, NCI measured a proportionate share of identifiable net assets, where the NCI is initially measured at the proportionate of net assets. Goodwill must be grossed up to in the non-controlling interest share of goodwill for the purpose of impairment test. Any impairment will firstly be allocated against this grossed up goodwill figure. Any payment in excess of this gross of goodwill will then be allocated against the remaining assets of CGU on pro-rate basis. So, another exam advice for you here. If goodwill is impaired in an exam question and the gross amount to the other assets, then test this adjusted carrying amount against the recoverable amount of the CGU. Ensure that you are comparing like with like, that is that the same assets and liabilities are included in both carrying amount and recoverable amount. Here is another example. Parent acquired 75% of subsidiary. The carrying amount of the subsidiary net assets on the reporting date was 1800. This included 300 of goodwill. Okay. The NCI was measured using the proportion of net assets. The recoverable amount calculated to all asset liabilities, blah, 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 was 1640. Calculate any impairment loss. Discuss how it is recognized. So carrying amount, goodwill, 300. Notional goodwill. Notional means assume 300 into 2500 divided by 75%, we get 100. Other net assets 1500. Total we get 1900. Recoverable amount is 1640. Impairment loss we got 260. The impairment loss is the first allocated to goodwill. In this case, the total goodwill of 400 absorbed all of the loss of 260 of this loss. 75%, that is 195, relates to recognized parent goodwill. 25%, 65, relates to unrecognized NCI goodwill. Okay. Only the loss relating to recognized goodwill is recognized in profit or loss. This reduces the profit allocated to owners of the parent in the consolidated statement of profit or loss. A recognized goodwill is therefore 300 minus 195, 105 after accounting for the impairment loss. NCI measured at fair value. Where the NCI measured at fair value, there is no need to gross up goodwill for the impairment as the NCI share of goodwill has already been recognized and included in the total amount of goodwill. Any impairment of goodwill is shared between the owners of the subsidiary in the same proportion in which the profits of the subsidiary are shared, even though the carrying amount of goodwill is unlikely to be split in same proportion. For example, an 80% subsidiary will reflect 80% of the impairment loss against consolidated retained earnings and 20% NCI. Example 10, impairment of goodwill. 2, parenting acquired 90% of the subsidiary. The carrying amount of net assets on the reporting date was 1900 and the carrying amount of the goodwill was 500, of which 25 relates to the NCI. The NCI was measured at fair value. The recoverable amount calculated to include all NCA assets and liabilities the subsidy on that date was 2200. Calculate any impairment loss. Discuss how it is recognized. Okay. Carrying amount 1900 and 500, 2400. Recoverable amount 2200. Impairment loss 200. Impairment loss is first allocated to goodwill. In this case, the goodwill of 500 absorb all of the 200 loss. The 200 loss is recognized in P&L profit or loss, allocated to owners of the parent and NCI in proportion to their ownership interest. That is 180 to owners of the parent and 20 to the NCI. The allocation of the loss is not in proportion to relative goodwill amounts. Okay, 47, 475 to $25 is to 19 is to 1. Recognized goodwill is therefore 500 minus 200, that is 300 after accounting for the impairment loss. So here another exam advice: if required to adjust pre-populated consolidated spreadsheet for a goodwill impairment, think carefully about how much, if any, of the impairment needs to be allocated to NCI. Now another activity we have, Cliff acquired 90% of equity shareholding in Hinge on 1st January 2007 when Hinge had required retained earnings of 2500. A draft consolidated statement of financial position at 31st December exit has been prepared, in which the separate statement of financial position of Cliff and Hinge were aggregated on a line by line basis. Goodwill of 50,000 recognized. No further adjustments have been made. Following is an extract. Share capital 2000, retain earning 15460, NCI 290, 17750. The following information is relevant. In the year ended 31st December X7, Hinge made profit of 540. In 2000 it made losses of 80,000. Losses and poor trading conditions triggered an impairment review of at 31st December X8 and an impairment loss of 270,000 was identified. Cliff operated a share option scheme for its employees and granted 1,000 options to 500 employees on 1st January exit. At this date, the fair value of an option was 3.40. The option vests on 31st December X9 on condition that employees remain in service. None are expected to leave company. The share option expense has been credited to retain earnings. Adjust the draft extract from the consolidated statement of financial position of Cliff at 31st December X8 in order to prepare correct statements. So, how to approach this question or this activity? Firstly, use a draft extract from the consolidated statement of financial position as a starting point. Make each necessary adjustment separate adjustment column. Read the information to understand how the draft statement has been prepared and what adjustment, if any, have been made, incorporated. Deal with each adjustment in turn, remembering to reference working when preparing a statement of financial position. It may be useful to think about the double entry for each adjustment to ensure that the balance is maintained. Finally, at each line across to each corrected field. Okay, here it is. NCI profits, share capital 2000, no changes, corrected. Here it is. Sorry, retain earning 15460. In net profits, it is reduced by 46. Impairment loss of 243. Share options 850. Negative total, we will get 14,341. Share options reversed 850. Corrected statement, we get 17,171. Non-controlling interest 290.46. Negative 27. Impairment loss total 309. That's it. Now, for the workings NCI profits, the NCI share of profits since acquisition is included in a retained earning but must be transferred to the NCI. 540 minus 80,000 into 10%, that is 46,000. The note, see, the question states that no consolidated adjustment have been made other than to recognize goodwill. The fact that goodwill has been uh, recognized when the NCI at acquisition must also have been recognized and the share capital pre-acquisition reserves of which must have been eliminated since all of these entries are part of the journal to recognize goodwill. The 290,000 in the draft, the statement is therefore the NCI at acquisition and the draft retain earning balance of 15,000, 15.46 million is includes retain earning plus all of H post acquisition retain earnings. The impairment loss is attributed to goodwill and allocated between Cliff and NCI in proportion to NCI. Because the NCI was measured at fair value at acquisition, retain earning to 70,000 into 90%, 243,000. 270 into 10%, 27,000. Share options, you can see exercise should have been credited to separate component of equity. The amount is 1,000 into 500 employees into 3.40 divided by 2 years, 850,000. So this is it. I hope you got the example and you understand the area of this goodwill and in consolidation at this level of SBR, right? And if you still have any problems, any issue, do not worry. You can ask me on my WhatsApp anytime. On my this WhatsApp, you can ask me your query anytime. No worries at all. See you soon in the next session. Till then, take care. Bye bye.